Tobias, your target for the S&P in June 2021, just a bit higher than where we are right now, 3160. Given that, how should investors be positioned? Is it just a matter of averaging back in if you're not in the market and doing it cautiously, or what do you expect?
So I think you just put it perfectly and cautiously using that terminology. I think the market right now is a bit ahead of itself, so we do think it's a little bumpier road going forward in the nearer term. Four key issues to worry about. One is the unemployment numbers, how quickly they come back. The fact that most of us will probably be somewhat in terms of practicing social distancing, not going back to normal until there are things like vaccines. Commercial industrial lending standards data suggests serious tightening of credit conditions, which usually is the economy by 9 months, which means no big bounce really in the fourth quarter. And lastly, if you kind of think about the elections and will businesses really want to step up in an aggressive way in front of those elections, or will they wait to see the results just in case there are some major policy changes?
Right. And Sam, I wonder at what point do political polls start to really affect the markets, given President Trump seems to be setting China up as sort of a foil in this election year? Is it going to get to the point where if the president is weaker in the polls, people read something into what's likely to happen with trade in 2021 and beyond, and if he's stronger, something else?
Well, I would actually say that the market itself is a poll. And if you look to July 31 through October 31 of presidential election years, historically, it's been a very good indicator that about 85–90% of the time, if the market has gone up, then the incumbent person or party has been reelected. If the market went down in that 3-month period, then the incumbent was replaced. So I would actually say, yeah, you could look to the polls, but at the same time, look to the market as its own poll.
Yeah, Tobias, I'm curious. I know you just used the word cautious, but when you look at how the week actually started, the sectors that were performing the best, the fact that you did see those treasury yields tick up, I realize there's a breather happening right now, but this idea of a so-called reflation trade, is that something that is kicking around in this market? Is it attractive? Are there certain areas where you would actually be playing that?
Sure. So let's break it down in two different ways. One, if you look at the market, and there's been a lot of narrative like focusing on the FANGs or kind of the big large cap tech companies, the beneficiaries, if you like, of the pandemic. If you look at since the bottom, March 23rd, actually an equally weighted S&P 500 move has equaled that of the market cap weighted. So it's actually been a little bit more broadly based here. And it's not necessarily cyclicals versus defensives. It's really been impressive in that regard. I think the thing you should look at is not just the 10-year Treasury yield, but you should also look at TIPS break even. So what is the bond market saying about kind of cyclical recovery, inflation prospects? That's actually doubled off the bottom, and you don't see that in the 10-year yield necessarily. The other thing is, and I do want to point out this term caution, one of the reasons we're cautious is our primary sentiment metric, which measures positioning, not feelings, is now in euphoric territory. We got a similar signal in January before the market sold off. We got a similar signal in September 2018 before the market sold off. So we are worried that the market's a bit ahead of its skis here.
Yeah. Sam, how about the ratcheting up of tensions between the U.S. and China? Obviously, we just had that bill that went through the Senate yesterday. The rhetoric continues to get more pointed as well. How much of that is priced into this market?
Well, I think that the additional bill is probably, or something is priced into the market at this point. But the market, I believe, as Tobias implied, is now in a waiting game, waiting to see what kind of an effect that the reopening of the economy will have on second quarter GDP estimates, as well as corporate earnings forecasts. Also looking toward other things such as additional announcements of virus injections, virus inoculation capabilities. Also looking toward, what's the possibility of a resurgence in the COVID cases. So I think there's an awful lot that the Wall Street will be looking out for, but still has to wait several weeks or months to get a better read on it.